US and Japan deal signals structural shift in global asset prices. Last week, the US and Japan signed a new trade agreement, and buried within it is a key detail. The US will impose a 15% tariff on Japanese goods. Surprisingly, Japanese stocks jumped on the news. Why? Because markets had feared something worse. A 15% tariff is seen as a relief. It's the shoe-dropping moment. So, in the short term, it's actually a positive surprise. But here's the thing, as market observers, we need to zoom out. The real impact of this agreement goes far beyond a one-day stock rally. Let's talk about something called capital recycling. Here's a simple way to understand it. Think of Japan as a neighborhood store and the US as its biggest customer. For decades, Japan has sold far more to the US than it has bought, and in return, it's been stacking up US dollars. That's called a trade surplus. But Japan doesn't just let those dollars sit idle. Instead, it uses them to buy US assets, mostly government bonds, but also stocks, real estate, and more. That's what we mean by capital recycling. In short, Japan earns dollars by exporting, then lends those dollars back to the US by investing in its assets. Over the past 20 years, Japan has bought nearly 3 times more foreign assets than foreigners have bought from Japan. It's been one of the biggest buyers in global markets. But now, things are changing. That 15% tariff? It's like the US putting up a toll gate and saying, if you want to sell here, it's going to cost you more. Keep in mind, the previous average US tariff on Japanese goods was just 1.5%. What happens next is simple. Fewer exports leads to less dollar income for Japan. And if Japan has fewer dollars, it naturally can't invest as much in overseas assets, especially in US treasuries. We're already seeing signs of this. Even though US bonds are offering attractive yields, Japan's appetite is fading. Now, some seasoned traders might bring up carry trades, where investors borrow yen at near zero rates to invest in high-yield currencies like the dollar. Yes, that's part of the picture, but carry trades are short-term, fast-moving capital. What we're talking about today is Japan's long-term investment power, its war chest of foreign reserves. This affects how Japan invests over years or even decades. Compared to this, carry trades are just a drop in the ocean. So here's the bottom line. This US and Japan trade deal may feel like a relief for now, but in the long run, it could undermine Japan's ability to invest globally. And that means we could be entering an era where Japan, once a powerful buyer in global markets, takes a step back. For the US bond market and for global asset prices, this is a structural shift worth watching. A quiet turning point may be unfolding before our eyes. This is Ultima Markets, giving you a step-ahead view of the market. See you in the next update.